Fast forward to today, we've raised 165 million. We can go up to 190 even, I think. So we're at, call it 25 million left in Fund 3. And then Q1, Q2, we'll start raising Fund 4. That'll be a $500 million raise. And that's when some of these big family offices in the Middle East can get involved, because they're 20 to 50 billion a lot of times in assets under management. So they're gonna write a $25 million check minimum. So they don't want more than about 5% exposure.
Today, I'm talking to Scott Ryan. Scott is the managing partner of Terra Rossa, which is a family office that largely invests in $3 to $10 million companies, so companies that are already established. I did not know much about family offices. I've spent the last couple of years kind of dipping my toe in, learning the details, having friends that have been involved. This conversation really breaks apart the value of a family office investment for an entrepreneur. So we dig into the difference between what Scott does and what a venture capitalist does, what private equity does, and when it makes sense to work with them. Scott's going to talk about a whole bunch of different details, but you should listen to him because not only is he the managing director of the family office and the fund, but he has exited 3 tech companies of his own, the last one being an 8-figure plus exit. So he knows what he's talking about from an operational perspective, and he has a lot of granular details on raising money. So he's going to talk about special purpose vehicles, qualified small business stock, some granular details, but also strategy behind the whole thing and what you as an entrepreneur should be looking at if you're taking on money. Whether this is the moment that you're thinking, I need money to grow my business or not, one of my beliefs in general is that if you can plant some of those seeds early or when you have an opportunity, when the time comes, you'll have some foundational idea of what's going on to point you in the right direction when you really need to dig in. So check out this conversation with Scott Ryan. We're talking investments, we're talking raising money, we're talking being an entrepreneur and hanging out in Austin and probably drinking some wine, because one of the crazy things about Scott and their family office is they have a sommelier on staff that just comes to the events and pours wine. So Terra Rossa is amazing. And so is the conversation with Scott Ryan. Scott Ryan, I appreciate you hanging out, man. Thanks for coming down.
I appreciate being here.
Yeah, man. So you have a super interesting story for me because you've run and exited 3 companies. Mm-hmm. Is that right?
Yeah.
And now you run a pretty interesting fund. And I want to talk about the nuances. What we were yapping about before we started was your journey led you to running this fund. And when I first met you, your narrative was, yeah, I did all this stuff. I operated, I sold, I executed again, I sold, I executed again, I sold. And then I found this thing and holy shit, why wasn't I doing this thing the whole time?
Right. No, that's exactly accurate. Yeah, my background is, went to the University of Texas, history major, minor in economics and Spanish. So I was prepared for sales, and that's about it. So that's what I went into. I went into tech sales up in Dallas. Worked for some, a phone equipment company, then worked for Sprint, learned the router out world, and then got interested in the router in, right, the tech space, where I thought that more money could be made. So
what is router out versus router in?
Router out is like telecommunications. You're selling a commodity. Router in is services inside your LAN. Then it evolves into the wide area networking and whatnot. And so, I got into the services piece, the consulting piece, right, where you can grow, sort of scale exponentially. So I had a recruiting company, contract and perm, and then I had a that launched an e-commerce company called Skywire that we sold to Oracle. Had a mobile app called Shop Savvy we sold to Eduardo Saverin of Facebook fame. And that whole time I had what's called an MSP, a managed services provider, that sort of had all these really smart engineers working on stuff, keeping networks up and running, but they also had good ideas that we would spin out. That was the good news. The bad news is I ran that company for 15 years. And by the time I needed growth capital, we were too late stage for VC. And so I just had to organically grow it and then sell it. And I had a really nice 8-figure exit, but it took more than a decade.
Right.
And if I had growth capital, I could have grown it much quicker. And so, you get to what I call a lifestyle business where you're making good money and you're like, do I want to risk this money or do I just want to keep pulling money out of it?
Yeah, I can understand that.
Yeah. But, you always want to grow and you want to be bigger than the previous year. And, with IT support like that, an IT ops company, more money, bigger, more problems, basically. So it became, difficult when it got large. So we sold it in June of 2016. And then I moved into, started investing in private equity with different masterminds. And so I saw a lot of private equity deals that I liked. I put money into it and I bet big, like I had always bet on myself. And that didn't work out so great. So I decided to move into the private equity space, go get all my licenses, learn the fundamentals. And then what happened is I ended up working with a client out of Canada. We raised some equity, in 18 and 19, and then March 2020 hit and everything stopped. And so, I was sort of looking for, this wasn't a tech fund. It was just more of a corporation. So it wasn't a fund. And then I bumped into, through a mastermind called GoBundance, I bumped into a guy named Christian Mack, who had seen the same problem. He had taken a company called Resolve Systems, grown it from 0 to 50 million, and had a big 9-figure exit with Insight Capital Partners, north of 180 million bucks. So long story short, he was targeting this very asset class that's too late stage for venture capitalism, too small for private equity. So think about an asset, SaaS-based businesses. So automation, machine learning, AI, software collaboration, software as a service. And they were, again, too late stage for VC, but too small for PE. So they're not bankable, right? There's no sell-side advisor that will represent them. They can't really go get debt because they're too small. Private equity won't take a look at them and give them growth capital because they're risky. We see these as huge opportunities, right? And the opportunity is to go in and take a business that's stable, say 5 to 10 million in revenue, maybe doing 200,000 to 2 million in EBITDA cash flow, and provide growth capital to grow sales and marketing, right? You fix the front office, you aggregate the back office, IT, HR, and financial services, and then those companies, if they've got a great product, they can take off. 90% of the time we take the CEO, and he or she has gotten them to 5 or 10 million. We turn them into a CTO and we plug in a new CEO because that existing CEO is good at product development, right? Normally they've got 10 to 15 clients that are Fortune 200 companies. So they're working for like 8, they've got products on, they're selling to AT&T, US Cellular, Department of Defense, JP Morgan, all clients that Christian had when he was running Resolve Systems. And then we've got a board of those very same people, ex-executives that work there that are now LPs of our fund. They often bring us deal flow, but they also look at the deal flow that we bring to the table and they socialize it. And so we do what I call sale and scale. We pre-sell that software before we acquire the company. So we normally have pretty explosive growth when we buy the company.
By selling into the rest of the members of the group.
Exactly right.
Got it. Yep. Okay, so I want to back out I want to actually start with the 15-year business. And then I want to break apart kind of the elements of the fund and the different groups of people that normally put money into these companies. But first off, the 15 years, what was the growth path for the 15 years? So you left with an 8-figure plus exit. What was the sort of growth ramp there?
Yeah. So, I think we were more lucky than good insofar as, we started with this model of a fixed fee, all you can eat IT support model. So pay me, $100, $150 per user. You're a 100 user law firm or medical practice or commercial real estate firm. And you're going to pay me 10 grand a month. Yeah. So we had a fixed fee, all you can eat IT support model. Right. And that worked out great. I think started it in 2005 and 2004-ish. And, for 3 years, which is 3 to 4 years, which is the life cycle of equipment, that's the model that we had. And
got it. So you were doing support specifically for the hardware that you knew was going to burn out in 3-4 years, and you're doing support for it?
Yeah, hardware and software. And we had, first 3 years we were growing, but when we exited, we probably had, I think we had 100 employees in Dallas and maybe, 50, 45 employees in the Middle East, in Manila in the Philippines. And what we were able to do there is do 24/7 support.
Right.
When we were growing, it was fixed fee. Then 2008 hit and, commercial real estate, all different groups were having a hard time paying us. So we flipped the model. We lowered the monthly fixed fee amount and then charged for products, but for projects, right? Certain, so if you had to upgrade from whatever version of Windows to another.
Interesting.
So that sort of catalyst, that moment of time, 2008, and, that gave us that opportunity to flip the script on that model. And so we became more profitable with the companies that needed more help. Right.
Interesting.
And the ones that didn't, we didn't have to charge them for projects. Right.
Did that require more staffing?
What happened is we got bounced by a number of clients, but they were probably the ones that would struggle to pay us anyway during 2008 and 9. So, it worked out pretty well. And, but again, I had another 8 years of growing that business. And as you would grow, you have to find employees that work. And, it's a slow brick and mortar kind of, build it one brick at a time kind of business. And that's where growth capital would have made a big difference if I could grow a stronger sales team, grow it faster, regional, across a number of different areas in the U.S. And I was limited with cash flow.
And that was all bootstrap?
Yeah, bootstrapped, exactly.
Got it.
Sold it to a strategic out of Houston, company called Center Technologies in June of 2016.
And what's the makeup of Center? Why did they want you?
They wanted us because we had the 24/7 model.
Got it.
You're paying guys in Manila, $1,600 and $1,800 a month, and that's a 30% raise over what Microsoft's paying them, and
wow,
and they're crushing it. Yeah, so it was really strong. So we have really strong, margins basically.
Got it. So they wanted your support team.
Yeah, that's right.
Including management.
That's right.
The whole ecosystem.
There's like 2 people that have left since I've sold that company. That's
wow.
So they're all still there. So they're killing it. Yeah, they're doing great.
Awesome.
Yeah.
What was the hardest thing about that? And what can you share where you were at in terms of like revenue profitability?
We're under NDA with Center, but the hardest thing about it is kind of like we talked about. As you get bigger and bigger, you just have more issues, right? Because in essence, you're inheriting whatever, it's like an attorney. The guy comes to him and like, here's the case, and you just inherit what you inherit. If they have old equipment, they haven't invested here, tight margins. We built a balanced scorecard to figure out who we would take on, but people change their mind, right? So as a result of that, what would happen is someone would be like, well, we're a medical business, and we're cash flow's tight, so we don't want to upgrade the equipment right now. It's like, well, there's a cost to that, right? So it's gonna be problematic if we push that out 2-3 years.
Got it.
More stuff will break. It's more expensive for us to maintain that network.
Yeah, sure.
So, and also, I think probably the most important thing is once you've run a business for 5 to 7 years, like how to do it. You're not really learning anything. So people are accelerating at a faster rate past you, right? I played competitive tennis growing up, and I always wanted to play against somebody who's much better than me, right? It doesn't do me any good to play with somebody who isn't as good as me. And when you're the CEO, you don't have any mentors. That's what kind of pushed me towards the mastermind groups, which I think are really interesting places to learn, to grow, and to figure out, what do you want to do next? So when I met Christian in GoBundance, we were in the champions group. He was a really interesting guy who had targeted this space. He had a really nice, 1.5 exit on Fund 1 over 3 years, about a 3.7 multiple on invested capital exit in 4 years and 4.5 years in Fund 2. And now they were buying companies in Fund 3, and instead of paying 3 to 5 times and selling them for 7 to 9 times like Fund 1 and Fund 2, in today's climate, we're buying at like 2 to 3 times revenue, and we're listing on the Toronto Stock Exchange initially at like a 10x revenue number. So the multiples are getting really attractive very quickly. So now is a great time to have dry powder. And we've raised about, our GPs put in about $30 million on a $150 million raise, which is impressive. I joined them in July of last year, and in, call it 15 months, we've raised about another $135 million, mostly through different mastermind groups.
Got it.
Yeah.
So this is actually one of the reasons I want to talk to you about it, because I think that the entire model is something that there's sort of this phase in business, and it happens to people at different levels based on what their profitability is, based on how much they take off the table, et cetera. But at some point, you need to figure out what you're doing with taxes, and you need to figure out what you're doing with cash, with the money you make.
Sure.
So all of these, there are this just litany of different investment opportunities and models that are out there.
Yep.
But inside the world of your fund, just the language around it alone is daunting for many people. And so you listen to anybody that's never done any investing, GP, LP, the multiples, why the multiples make sense, how it works. Terminology alone is a bitch. So I want to back out to you've got, you mentioned, and I'll hit the couple quick points, but you mentioned the GP, the general partners here, put in $30 million, which is a huge chunk of the limited partners, the people that you were raising money from, put in 130 to aggregate 160 for that total amount. And I want to talk about what you do with that and kind of break it apart. But you started by talking about the businesses that you target to invest in. And you started talking about sort of how they could otherwise get money. And so who are the players that normally are an option for small businesses to get money from at the different dollar amounts, right? At the different phases. Because you were talking about VC, private equity, et cetera, and you filling this gap.
Right.
But can you break that apart a little bit?
Yeah, for sure. So one of the think tanks in tech is called Gartner Group, and Gartner Group looks at looks at the U.S. based SaaS B2B enterprise space, and they say by 2024 it'll be like $762 billion. So you have a huge market. It's almost $1 trillion, right? They say
Specifically for SaaS, B2B SaaS.
specifically SaaS, yeah.
Great.
And that's what we know. So we stay with what we know. Now we have a 20% mandate, so we can take of that 160 million, let's call it, we can take out, what is that? $32 million, and we can basically put that into something that's different than our traditional mandate, our investment thesis. And what that is, we're what's called a buyout growth tech fund. A buyout meaning we take controlling interest, growth meaning, these are companies that are not startups, right? But, our job is to grow it. And it's a tech fund, right? SaaS-based specifically. And what we think is, in good times, these companies do really well. So collaboration software, automation software. Collaboration is, you have a distributed workforce. You're going to collaborate and figure out how to solve things. Automation is like, hey, let's resolve these things with software, not people, right? So during COVID, it's exceptional, right? Because you have a distributed workforce. You have companies that have to deliver the same amount of productivity with less talent, right? Less resources, people. And so automation takes a front seat, and, machine learning and artificial intelligence are really important to couple with the automation and collaboration technology. So it's a great space to be in. But of that 762 billion, you got 5% that fits into the VC model.
And what's the VC model?
VC model is 3 to 5 year old companies. These are less. They're new companies, and that you can hit unicorns. It's not unusual to get one winner out of 20. I was in Techstars fund, David Cohen's fund.
Sure.
And, that's Uber. I mean, Uber carried the whole thing almost. It's probably an exaggeration there a little bit, but there's, only a handful of companies out of the many, many companies he invested in. And he did exceptional, but he got in early stage on Uber, which is great. And then private equity are much more stable companies that are bigger. So what happens is once you get over 3 million in EBITDA, your Insight Capital Partners, your Platinum Equity, all these different groups start bidding on those companies. So you're going to pay a much higher valuation. So we're in that desert in between the two. Now, if 5%
in between venture capital and private
equity. So 5% is venture capital, 30% is private equity. That means 65% of 762 billion, $500 billion is the opportunity in the middle. It's massive. But private equity sees it as too risky. They do not want to invest in a company that's doing 250,000 in EBITDA, or $500,000 or $1 million, because they're like, yeah, that thing can go away in a minute. But what we do is these companies are 7 years old, call it, right? So they've got a great product because they're selling to AT&T. It's really hard to get on AT&T's vendor list. You have to have a strong product. A lot of times AT&T, like I said, an ex-executive will be like, hey, there's a company that we really like. They need growth capital to develop more products. And then, so we give them that, and then we build their sales and marketing team, and we provide that back office. So it's very niche oriented what we do.
Got it.
We always want to take a controlling interest because we want to replace the CEO, make him or her the CTO. We got to get along with them. We want them involved. So we like to buy 51%. We want skin in the game. They take very little dollars off the table because it's a growth fund. So that money goes into growth capital. And then we do a listing because like we did in May of this year, we listed on the TSX, one of our software automation companies called Edge Technologies. We listed it on the TSX, and we were able to do a cash distribution to our LPs. It's very unusual to do a cash distribution in a growth fund because all the money normally goes into growth. But we think that people want current yield, and this is all Christian's idea. I wish it was mine, but yield is what brings real estate investors and some other groups around to say, hey, this is kind of compelling to us. I've also been to the Middle East. My 6th trip will be in January. We've been in, Dubai, Abu Dhabi. We talked about this, Bahrain, Oman, in Muscat, the capital of Oman, and Riyadh, Jeddah, and Dammam in Saudi. And they also like yield, right? And they're heavily invested in real estate. Obviously, they're invested in energy. They've got a huge appetite for technology. So that's one place that we spent a lot of time with as we prepare ourselves to raise for Fund 4. Fast forward to today, we've raised 165 million. We can go up to 190. So 190 even, I think. So we're at, we've got another, what is that? Call it 25 million left in Fund 3. And then Q1, Q2, we'll start raising Fund 4. That'll be a $500 million raise. And that's when some of these big family offices in the Middle East can get involved because they're 20 to 50 billion a lot of times in assets under management. So they're going to write a $25 million check minimum. So they don't want more than about 5% exposure.
Got it.
That's that number.
So venture capital largely gets involved and lets the entrepreneur, and correct me where I'm wrong here, if I'm wrong, where I'm wrong here. But I want to break down kind of the difference between those three groups, right? Yeah. From your fund, which is part of a family office, right? Venture capital and private equity. Venture capital gets involved, very early stage, bets on the entrepreneur and the concept.
Right.
And maybe they have some strategic guidance or resources.
Sure.
But they funnel money into the concept and the entrepreneur.
Yeah.
Private equity, and they'll take, venture capital will take, anything from a few points to 10, 20, 30.
Sure.
But they're not taking majority usually.
Traditionally.
Yeah. And private equity is doing maybe a roll up where they're saying, hey, we're going to create more value by buying this one company and taking 20%, and then buying some other companies and stacking them together to create a bigger company that's worth more. Right. And they, but they're also usually, maybe they come in and help you operate, maybe they don't. But the aggregation model is common in private equity. Mm-hmm. And in the middle, you are doing a very specific thing, which is you're coming in, giving them money to grow, but you're also taking controlling interest, right? So 51%.
Yeah. We put a new CEO in, and we work with a group called CEO Coaches International out of Miami, really interesting group. They do a lot of executive coaching, but some of their coaches, if you will, want to get back in the game and they want to run something. So we'll do a 5-year stint with them ideally, and then and they can also recruit for us. They have a bunch of interesting services. But then we put on top of that CEO an operating partner. Then that operating partner may have 1 or 2 CEOs that he or she works with to make sure that they're hitting their numbers, right? There's an integration process, but if they start missing some of their milestones, we do what's called a restoration process, and then the acceleration process. So the really interesting 300-page playbook that Christian Mack wrote, I think I mentioned this guy's big brain guy. He was on track to get his PhD in mathematics at the University of Chicago, and as a side hustle, he started a software company to pay for school because he has humble beginnings, and he went in that direction, obviously. But he's a process guy. So he's built a process for how do you take a SaaS company from 5 to 10 million, 10 to 20, 20 to 50. Very different critical success factors, very different KPIs, and but it's simple, not to be confused with easy. It's like, okay, here's where AR has to get from 5 to 10. Here's how the changes you got to make in middle management to get from 10 to 20. Here's how you got to get from 20 to 50. We normally put in a CEO that's taken a company to 50 million before, so they're well versed in that process. But with the growth capital, unlike what I faced, and Christian as well ran Resolve Systems for 16 years, you can accelerate that process considerably. And since we have plugins to the JP Morgans and the Department of Defense and Oracle and SAP and IBM, we can immediately sell to those groups. I call it the sale and scale model. You pre-sell it, you get verbal POs, and by the time you buy the company, like we took our second investment that went public from like 400 to 1.5 million in EBITDA, and then launched them, then listed them, and it's a beautiful thing because not only do we get a market to market, not only do we get a cash infusion of growth capital that we can then distribute, but we get a market to market valuation. And
what does that mean?
Yeah, so you basically have the markets telling you what that company's worth. The reason that matters is we have a third-party liquidity provider. Think of someone who can buy out the investors, the LPs, before the time horizon. Ours is a 7 to 10 years is where we like to exit.
And in 7 to 10, you're exiting to who?
Yeah, you're selling. You can sell to a strategic. You can list it and exit. There's a bunch of different options, but we normally sell to a strategic. Is what we've done in the past.
Which is a strategic partner that wants to buy that company for some reason.
Right, exactly. Because AT&T, Oracle, IBM, they don't create a lot of their innovation. They acquire it, right? They buy it, right? Because it's instead of building a whole team and trying to create something, they find something they like and they just acquire it, purchase it. And so that's how a lot of them do their operations. But you can also sell them to a private equity group as well, right? You can sell them to an Insight Capital Partners or a group like that. So we have a lot of options in that regard. We, in Fund 1 and 2, it was 3 and 4 years respectively, because we like to get in and out. But in Fund 3, we're going to carry each company for a minimum of 5 years because we get what's called QSBS, Qualified Small Business Stock.
Right.
So it's able to lower federal capital, eliminate federal capital gains, which you still pay state taxes. So for those in California and New York, they're still dealing with that issue.
So sorry.
Right. That's why everybody's moving here. I mean, it's the
Right.
craziest thing in the world. I mean,
Yeah.
everyone I meet in Austin is from California or New York.
All
Or
right, so
wherever.
we got a lot of transplants.
That's right. So
Yeah.
so we have, I mean, I really like, and we also have something unusual, what's called an 8% pref. So we pay 8%, normally starts on the 2-year anniversary. So we're making our, we made a distribution in May. We're going to make a quarterly distribution November 15th. And based on the cash flow of our companies, because it's performance based, it's every quarter thereafter. That's what we've done historically. Doesn't mean we'll always make the payment, but we like yield. And our companies are cash flowing well enough to support that yield today. Because it's performance based, it's long-term capital gains. So you pay 23, 24%, whatever it is right now. So everything's really tax efficient. But, I then, with a lot of my, call it winnings for lack of a better term, my earnings, I'll invest in real estate to get depreciation and things like that from a tax perspective. But this is very tax smart, this private equity investment with really attractive upside.
Yeah. So I want to talk about the QSBS, but I also want to just solidify the concept. So you have let's talk just Fund 2 for a minute. So what was the raise for Fund 2?
We did a $32 million raise.
And how much was general partners versus limited partners?
General partner put in 9. Limited partner put in 12.
Okay. That's terrible math. 9, 12. 21.
Sorry.
Okay. So the first one was 21?
Yeah.
Second one?
The second was 21 invested.
Got it. Okay. So the 21 invested. And
that's a small fund, right?
Yep.
32 million small. Our first fund was 10 million, right? We invested like 5.5. So these are concept funds. So it's like we have an idea, right? And Christian's most of that money.
Got it.
He's got an idea. I think this is an asset class we can win with.
Got it.
Right? So,
So I want to talk numbers on that. So
you bet.
He puts in 9 because you're trying to prove concept on this.
He puts in like 4.5 of the 5.5 of the 9 that's committed.
Got it.
We only invested like 5.5.
Got it.
And maybe 5.2. Don't get me to lying, but
yeah.
So we invested 5.5, and we're able to buy, make I think it's 3 investments in Fund 1 and sell out those investments and get it was like a 1.5 multiple on invested capital. Right?
Great. So that's what I'm getting at.
Yes.
So roughly 10 million in the first fund.
Right.
We'll use that one. For 10 million in the first fund, 5.5 was investors that came in, something like that, a little over 5.
Yeah.
Were people that you talked to and they said, yeah, I trust that you will make money with this money.
That's right.
Here's 5.5. You went out, invested in 3 companies, bought 51% of 3 companies, and then fueled their growth by putting in a new CEO and an operations team to grow that company. And then those 3, the way that you close out the fund is sell all 3 of them.
That's right.
And then that fund is closed
at different times, but yes.
Got it.
Right.
And as you sold them at different times, you have elected to do distributions. Maybe not.
Yeah. So we can make quarterly payments, right? That 8%. And then it's called a waterfall. So how does the LP get his money back? He or she will pay the 8% first, and that's accumulated when the hard money goes in. So let's say we're going to do a real world example with you.
I like it.
You go, hey, I'm going to put $1 million in. Right now we've called 60%. So we say, hey, Brad, we need 600K from you. You put 600K in, you immediately start making 8% on that money, right? It accumulates. So we may try to make a quarterly payment to pay down that 8%. It'll be, anywhere from, 0 to 2%, right? Because we do it quarterly. So it'll be somewhere in that range. Now, in May, we made like a 2.7% payment. I think it's 2.67. And that was based on an IPO, but it goes against your 8% waterfall. Once we pay your 8%, so let's say we call another 20% in January, because we normally call each January. Now you're at 80%. We may not call the other 20%. Or we may call the other 20%. But let's just say you're at 80%. You got 800 grand in, you're making 8% on that. Once we pay down that 8%, then every other payment goes against your principal. Once we pay down all of your principal, then it's split 80-20. You get 80% of the proceeds, the exits, the winnings, and we as GPs get 20%. That's called the carry.
Got it.
Okay.
And what's the notion of a call on this? Yeah.
So the notion of a call is we'll typically call in January of each year 20%. Now, what's interesting about us is we're in our 3rd year. That's very unusual. Normally, funds will do a 1 to 2 year raise. We're in year 3. Why is that? Well, they started in August of 2020. And then when I met them in, October, call it November of 2020, I was like, you guys are about to raise another fund. They're like, well, we've already raised 32 million. We've put in 20. And I said, where did the other 12 million come from? It came from fund 2. And I was like, so you haven't raised any new money.
Oh,
and they're like, well, but we raised 32 million. I mean, that was fund 2, 32 million. We're already at 32 million. And I'm like, well, it's pretty shark infested waters out there. Again, you got to remember, this is like November 2020.
Yeah.
We're still in the middle of COVID.
Yeah.
So I came on in July, and what we did is it was $1 million minimum investment. Again, these institutional grade investments, normally people don't have access to these. So, I sat down with Christian and we talked about, I was like, what if we lower this number down to like 150?
Mm-hmm.
Okay. What if we also we can set up some what are called SPVs. We have different masterminds set up groups and give access to those masterminds. So it's an SPV.
Special purpose vehicle.
That's right.
For a specific mastermind.
That's right. Right.
Got it.
And they can come in through that SPV at a lower minimum than directly coming into the fund. And then that typically, if you come in through an SPV, there may be additional fees and whatnot. Our masterminds agreed to do a 1% origination fee. So if you want to come in at 150K, you pay an extra $1,500. That covers your K1s and all the work that SPV has to do on your
tax
behalf.
work in the back end.
That's right.
Yep.
And so we created these SPVs. This is really exciting, right? Because we're an institutional grade fund. We have, Kirkland Ellis is our law firm. Armanino is our CPA firm. Northern Trust is our firm administrator. These are expensive, folks, and it keeps it a very high level institutional grade. That's why it's normally $1 million minimum.
Mm-hmm.
But I wanted to give this asset class, I wanted to give people that, may only have, 150 to put in, to get involved and to understand these great upsides.
Mm-hmm.
So we work with a handful of masterminds as a result, and most of the money that we've raised has come from masterminds.
Interesting.
Even though we have some institutional investors, we have a foundation, we have 5 what are called fund to funds, people who build a fund and then invest in a multitude of funds. So we have those institutional grade folks as well as RIAs.
So pull me back to the concept of a call. So let's say that I commit to $1 million.
Yeah.
Is it that I put $1 million in and then you have the ability to call more later? Or is it that I commit $1 million, but I put 500 grand in the beginning?
Yeah.
And then I'm subject to your calls at any point in time?
No, that's right. It's the latter. It's a good
Okay.
question. So what we do, this is another huge benefit for the investor. We say, hey, if you want to put it all in, you can put it all in. It's kind of a new thing that we do because right now in this time and space, the valuations are fantastic, right? Because if you think about it, let's say in, fund 2, we got a 3.7 return on capital. That's, it's what's called MOIC, multiple on invested capital. If you're buying at 4 and you're selling to a strategic and you get a 4x multiple, just making up numbers. If then in fund 3, you start buying at 2, that's an 8x multiple just out of the gate with the same performance as fund 2. Does that make sense?
Mm-hmm.
Because you're buying at 2, not 4.
Mm-hmm.
So the buy is one of the most important aspects of the success of your fund. Because if you buy wrong, even if you're a fantastic value add, you're just never going to get those bigger multiples.
Right.
And if you buy right, and you can wait out the market as it picks back up. I mean, there's a ton of compression going on right now. And when I speak about compression, keep in mind, if you're not paying 4, you're paying 2. When you exit, when you list, if the market hasn't healed, then you're going to get compressed on the list too.
Right.
So,
yeah.
Right. So you may not get that big win, but we're holding for 5 years because of QSBS. So we're highly convinced that 5 years from now, the market will pick back up. And
yeah. So let me extrapolate a little bit and then get into QSBS. So when you say the buy, you're talking specifically about how the fund allocates the capital.
That's right.
So what companies the fund buys.
Yeah. How we acquire a business.
Yep.
What's the valuation?
What's the current valuation?
Right.
And because of the recession, the change in economic times.
For sure.
The multiples are just lower for
Yeah.
businesses. So the companies that were getting valued at 5x are now
Yeah.
getting valued at 2x.
It's also a perfect storm. Not only that, right. So the valuations have lowered.
Mhm.
Like that's just the economic climate, the market.
And what your thesis is here is that by the time you're going to sell them, the economic market will have risen again, and the multiples on that same company will be back to what would have been 5.
Sure.
And you would have done the value add. So now they're back to 10, 15.
Yeah.
Right.
And I would tell you that we're truly disrupting private equity because traditional private equity, again, think of the 3 million and up. Those guys are the ones who want to buy the company from us and then they want to go list it or go sell it to a strategic. So we then list it. Now we have a market to market valuation. There's not a lot of negotiating on what the valuation of that company is. So the private equity, they've lost maybe a turn or two, right? And we've picked that up, hopefully.
You're skipping the private equity chapter of this.
That's right. I'm exactly. I'm right.
You're taking it from this gap that PE doesn't want to play in straight through the PE space.
Sure.
To sell it to the partner that PE would sell it to anyway.
That's right.
Got it.
Or to PE at a market valuation that's been created in the public markets.
Got it.
And hopefully it's picked up, right? But 5 years is a long time. I mean, if we're still in this place 5 years from now, we've got bigger problems. Right?
Yeah, that's the truth.
But what's interesting is what's called a CAGR, or compounded annual growth rate. The CAGRs that we see inside automation and collaboration software are really aggressive, 20, 25% growth models.
Mm-hmm.
However, we're not competing with anyone. And I would even argue that because interest rates have climbed significantly, these companies in this desert that we'll call it, this asset class that we service, they can't go get traditional debt, like a line of credit or bank debt.
Got it.
Because it's expensive.
Yeah,
so
especially right now.
Right. So they're like, why don't we just give up equity? So it's a great opportunity for us.
Got it. Okay, so let's go back to the QSBS thing.
Yeah.
Because this is like ringing a bell for me, but fuck, there are so many different little tax nuances. It's impossible to keep them straight in my head for me.
Sure.
Or that's my current belief. But tell me the nuances of that.
Yeah.
As you know them.
Right. And I'm not a tax consultant, so anything I say can and will be used.
Right.
No, I mean, you gotta go talk to your tax guy. But the way I understand it, or what's been shared with me, is that if you buy companies and you structure them a certain way, and they're under 50 million in revenue, and you hold on to them for 5 years, it's a little bit like opportunity zones, right?
Mm-hmm.
Where the government, it's like a 30-year-old program, and they're like, hey, we want people to inject growth capital into small businesses.
Mm-hmm.
So this is a way you can put money in, grow the business, and then you don't pay federal capital gains on the exit.
Yeah, pause. And so the comparison in real estate are the opportunity zones, where if you invest money in certain areas in the city, growth areas that the city or the government wants to grow, they incentivize that by not charging tax for X amount of time or reducing
it's
your
like
tax.
10 years, isn't it? In opportunity zones. This is 5.
Yeah, it's amazing.
Yeah. So
and here it's if you invest, if you buy, is it a certain business class that you have to buy in?
Yeah, not that I'm aware of.
Okay, so if you buy any business,
it's my understanding,
and you hold for 5 years,
you hold for 5 years, and it's got to be smaller. It's a smaller company,
under 50 million.
Yeah, exactly. Yep. And so,
still a pretty big window.
Yeah. No, it's a great opportunity, right? Yeah, it's really nice for us.
Then it's no cap gains,
right? So we won't necessarily always wait the 5 years.
Sure.
If we get a deal that we got a 33% return on a deal we bought. We bought it, and we knew we had a buyer. It was our first investment in Fund 3. We just flipped it. Like 9 months. It was a great return.
Yeah.
So we'll do that, but where it makes sense, we'll hold on to it for 5 years. Our second investment, we bought at the beginning of the fund. So we will be, we're in year 3 right now. Mm-hmm. So it's another really exciting thing. Because of COVID, we extended the fundraising timeframe, but then those SPVs then can go even longer than Fund 3. So the way you get in now is through the special purpose vehicles, and there's no catch-up fee, which is unheard of. So you're investing the same time that the LPs who invested originally in the fund invested. But you don't have what's called a blind pool risk. We've made 6 investments, so you already know that we've got our investments.
Got it.
Those companies are growing. We're already doing cash distributions. So, if anyone gets in before November 15th, they'll enjoy that cash distribution.
Got it. So you're in Fund 3 right now.
That's right.
And so people started investing in Fund 3 a year ago, 2 years ago?
August 2020.
Okay, great. So 2+ years ago, people started investing. And they, at the time, this blind pool risk was they were investing in the fund based on the fundamentals that they know the operators, the fund itself.
Hope those guys know what they're doing.
Yep.
They did okay in Fund 1 and 2. Doesn't mean they're going to do well in Fund 3.
Yes.
But maybe they could.
And yes, exactly. So that's when you raised this big chunk of money. But then along the path, you opened this up to masterminds and created special purpose vehicles specifically for the masterminds. Yeah. And you still have some opportunity today to invest in one of the SPVs.
Sure.
And that's how you get into the fund. But the big difference, you said, is you don't have the no blind pool risk, is that you now see all the companies that you've already bought.
Yeah, you see how they're performing.
Yeah.
And then you don't have to commit $1 million. You're like, hey, I'm going to dip my toe in the water. I want to put in 150. In fact, I only want to put in 60% of 150 or 90K.
Oh, right. Because you can also keep the other portion up for a call later.
Or you can put it all in, Or, we've had a couple of the LPs, they put money in and then something happens, death, divorce, whatnot. You can sell out your position to the third party, what's called third party liquidity provider out of Dallas. They're called Beneficient. They'll buy out an LP at a 20% discount to net asset value. So whatever the value is today. And right now our net multiple on invested capital is 1.2. And what does that mean? That means if you put $1 in, it's worth $1.20 right away. And that means you're out of what's called the J curve. When you buy these companies, normally you have to invest money in. So there's a J curve. It's literally a J shape, right? And for a year or two, a lot of times they're losing money, and then they take off. Or you have to invest more than is actually coming out of the business because they need that growth capital. We're at 1.2. We're out of the J curve. This is, nothing safe in life.
Sure.
But this is a much better time than 2.5 years ago when other people invested. The other thing to think about is what's called the investment horizon, right? We want to get out in 7.5, maybe call it 8 years. So there's only 5 years left, right? Approximately.
Yeah.
So that you're in and out in 5 years. You get the QSBS. You can sell out early if you want to do it through the third party liquidity provider. You get 8% pref. There's no blind pool risk. Your minimum is lowered. It's nice.
And the downside is that maybe you fuck it all up.
as with everything in life, right.
So, but the QSBS is actually like, just to hammer this point home, that's functionally a 23% benefit. Like that's a huge difference.
It's fantastic
to not have any cap gains. And
we have to be better, right, Brad? Because at the end of the day, I'm competing with KKR, Carlisle, Apollo. Now they may get 9, 10, 11% returns. We've got to be better than them to get people's attention. And, it's working, right? Certainly in the Middle East, it's working. And it's working inside masterminds, right? Because, if you can get similar yield, right, on a 8%, whatever that magic number is, but then you can also get the upside upon the exit, and then you got a tax benefit there as well as a liquidity benefit. You've kind of covered a lot of your bases, right? And you've hedged a little bit as it relates to traditional private equity, which is normally you put your money in, they spend 5 years buying companies and then 5 years exiting. So you put your money in and you look up 7, 8 years later and you haven't gotten anything until until they exit, right? And a lot of times they don't work.
So talk to me about this model, and obviously you've got your unique selling points for yours.
Yeah.
What are the competitors to you in terms of other funds? What are the differences in how they operate?
Yeah.
So in this space, we talked VC, we talked private equity, and kind of how they operate. And your model is replace the CEO.
Yeah.
And put an operations team in place and have an injection of cash to grow marketing, right? To pump this thing out.
Yep.
How do other funds operate the same way inside of
It's a great question.
This ecosystem?
So, this, and I'm not going to dig on private equity people in a negative way at all, but it's going to sound like it. So
I'm okay with that.
Right. So what do you see traditionally in private equity? You see a lot of really sharp, guys and gals with high pedigrees that have, MBAs in finance and accounting. What they're good at is they take a company, they restructure the debt, they provide financial acumen, and then they sell it. That's not what we do. All 6 of us in the GP are operators. We've all had exits, some of us multiple exits, And so we know how to build businesses, right? And and we've done it arduously, 15 years for me, right? But now I see, and as does Christian and a multitude of guys on the team, Brett Paulson, who's here in Austin as well, is a new addition. He's a great guy as well. He got his electrical engineering degree in the University of Texas, and then he went to Stanford and got his MBA there. But he's also grown businesses and sold companies. We've got a guy named Dan Chen. He was a portfolio manager at TPG, and he basically took distressed companies, grew them, and sold them. So we have operators who've actually done that. It's very different than traditional private equity. We've now grown to where we have both of those players. Guys, we got a guy named Ari Bass who has an MBA in finance and accounting from USC, and he's really strong in the deal structure side. We have another gentleman named Josh Green who worked at the Michael Milken Knowledge Institute. So we've got strong private equity guys as well, but we started out as operators, and we do a balanced scorecard on the companies we buy based on being operators. So it puts us at I think a competitive advantage insofar as we look at a company. Is this a viable company? Not to buy and flip, but can we add the value to really grow it? Because that's where the money's made. It's not just when you buy it right, but if you can grow it and put that value add in place, then now you have something that at that higher level, right, at a 2 to 3 million multiple, now you have that feeding frenzy with the inside capital partners, and they all compete to buy that business. Or you can list it and you're like, here's the new price. And they're like, yikes, now we gotta stretch and buy it at that price point. So I think that's where we play really strongly.
All right. So I'm going to rephrase that, which is, in my head, venture capitalists are betting on the entrepreneur and the concept to blow the business up. And it's a roll of the dice. PE is betting on maybe the economics of the business and being able to restructure and resell. And if anybody that would want to invest in a fund, in your fund, or maybe any fund, but want to invest in the fund, in this case, they're betting on the operators of the fund being competent and capable as business people to actually add value to that business, ultimately so that PE or the market will look at it and say, shit, that business has strong economics internally, right? A strong balance sheet, strong P&L. It's worth a lot because of that.
Yeah. And I would even add to that, we pick certain platforms like Kubernetes is a technology that has, 25% compounded annual growth rate. So we buy companies on that platform, and then we do what are called follow-on or bolt-on investments. So you're buying small companies to bolt onto that company at really low valuations, really beautiful valuations, but collectively we're doing exactly what a strategic would do, is we put them all together and then they're worth significantly more as we exit.
I love it.
Yeah.
Cool. Well, I think the structure of these things is fascinating and the devil's in the details. So I like picking them apart.
Yeah, sure.
And it's also, you've made a point of trying to make it accessible to the mastermind groups that you're participating in by reducing the amount to get in, and the SPVs make it flexible for people to get in at different points in time.
Absolutely.
I just think that's awesome for people. And, there are thousands of different investment opportunities. But knowing the details is what allows people to be comfortable and safe doing it, as safe as they can be, right?
Absolutely. Well, and I think this is where all of a sudden, whether you're, when you look at a fund that's 165 million, call it, if 30 million have come from the GP, that everybody's walking the talk. I mean, I've got 2.25 in myself. That's a big number for me. Christian's got about 15 of his own monies in there, 15 million. And so, we're in it for the multiple that the LP is going to enjoy, as well as the carry. Traditional private equity puts 2% in. So on a $150 million fund, that's $3 million.
Right.
Like, that's it.
Yeah.
I'm going to get the carry. They also charge a 2% management fee.
Right.
So
they're making money no matter what.
They're making money no matter what. And they're not really putting that much risk in.
Right.
We're risking a lot because we're like, no, we believe in the process. We've done it twice before. Doesn't mean we can do it again, but like the market conditions right now are something that I haven't seen in a decade.
Yeah.
Really like since 2008.
Yeah. Well, that lesson is just something to live by as a human, but also as a business person. Like, follow the money.
Yeah, for sure.
Look at the incentives that are in place.
Yeah.
And make and that hedges risk, right? That helps you mitigate risk.
We got a verbal from our law firm that they're going to put in an 8-figure number, and it's pretty tough to get checks from attorneys. But, but they've seen us on fund 1, 2, and 3. So they're going to invest in fund 4. That's a really good sign for us. And it allows us to bring in other institutional investors as well. So, that's all real positive. But right now for the accredited investor, somebody who's at $1 million net worth or so, and the qualified purchaser, which is 5 million and up, they get access to our institutional grade investment without having to write a really big check, which is nice. They can get comfortable with us and then decide if they want to go again in fund 4.
Cool. I dig it, man. Well, I appreciate you taking time to carve it out and explain the details. If people want to find out more about you or about the fund, where do they go?
Give me a shout.
Cool.
Scott Ryan, 214-207-0600. Uh-oh.
I love it.
Hey, thanks, Brad.
I may replace that with a link.
There you go. That's probably a good idea. But hey, this is an honor to sit here with you. I mean, you're a big deal. I've heard about you from a lot of different folks. I was thrilled to get to know you during Formula One. We had a great time here in Austin.
Blast.
Yeah, it was really good. It was a really good time. And so really enjoyed that. So thanks so much for allowing me to share this really cool investment opportunity with your constituents. And I hope to be back.
Love it, man. Appreciate it. Always good to see you.
All right, buddy.
Love it. I hope you enjoyed the episode as much as I enjoyed doing it. I need your help. There are 3 places you can find Beyond a Million. The podcast itself, beyondamillion.com, which has some cool free resources, including a free course. And we finally launched the Beyond a Million YouTube channel. I would love it if you would go there and subscribe. And if you don't want to, you still would probably enjoy seeing the visual content. Check it out, youtube.com/@Beyond a Million.